Comcast's unexpected decision to split its media and technology businesses has sent shockwaves through the stock market. With shares soaring 23% in just a day, the implications are vast for investors and the industry as a whole. Here's everything you need to know. As Comcast embarks on its separation strategy, several critical developments are on the horizon. The company is poised to finalize its spin-off timeline, with shares of the newly formed entities expected to commence trading by late 2026 or early 2027. This strategic pivot represents a significant transformation in Comcast's operational framework, aimed at streamlining its businesses and enhancing shareholder value. By focusing on distinct sectors, media and technology, the company hopes to unlock greater potential within each division. Investors may reassess their portfolios, potentially reallocating resources into either the pure-play media or tech wireless markets. This realignment could indicate a growing confidence in specialized firms that concentrate on their core competencies rather than sprawling conglomerates. The potential impacts of Comcast's restructuring extend beyond its immediate financials. Market observers are keen to see how competitors might respond, particularly if Comcast's separation proves successful. Increased regulatory scrutiny is likely, especially concerning NBCUniversal's global media influence and Sky's operations in Europe. This could ignite discussions around monopolistic practices and market competition at a time when consumer preferences are rapidly evolving. As market sentiment shifts, the tech-heavy NASDAQ, recently experiencing a 5-day losing streak, may witness renewed interest in non-tech sectors, reflecting a broader diversification trend among investors. Additionally, economic indicators, including the upcoming June non-farm payrolls report, will be closely monitored for insights into overall market health. The pivotal question remains: how will Comcast's restructuring reshape the media and technology landscapes, and what implications will this hold for investors and consumers? As the industry adapts, stakeholders must brace for an era characterized by innovation and strategic agility, with Comcast's actions potentially setting a new standard for future corporate transformations. The decision to split Comcast into two distinct entities marks a significant turning point in the media landscape. This move reflects a broader trend in the media tech convergence era, where traditional companies face mounting pressure to adapt to the rapidly evolving digital ecosystem. Over recent years, firms have struggled to compete effectively with streaming giants such as Netflix, Disney+, and Amazon Prime. These platforms have disrupted traditional business models, prompting companies to rethink their strategies and clarify their core competencies. Comcast, which has operated simultaneously as a media powerhouse and a connectivity provider, has encountered unique challenges that limited its market valuation. The dual role created complexities that ultimately hampered growth potential. Recognizing that maintaining both identities under one corporate umbrella was detrimental, Comcast's leadership made the strategic choice to separate. This decision aligns with regulatory shifts and the increasing integration of AI technologies across various sectors. Companies like British American Tobacco have also undergone AI-driven operational changes, highlighting the need for clearer strategic focus in today's competitive environment. Historical parallels can be drawn with previous corporate restructurings, where companies have successfully split to enhance market performance and shareholder value. The impact of this separation could be profound, as it allows each entity to pursue tailored strategies that align with their respective markets. This adaptability is crucial in an industry characterized by rapid technological advances and shifting consumer preferences. Looking ahead, Comcast's split may serve as a blueprint for other companies grappling with similar challenges, encouraging them to reevaluate their structures and focus more intently on their core businesses. As the media landscape continues to evolve, the success of Comcast's decision will likely influence future corporate strategies in the industry. The separation of Comcast's businesses into distinct media and technology entities marks a pivotal moment in the corporate landscape. This strategic decision allows each division to be independently valued based on its core strengths. For the media segment, this means investors can concentrate on a pure-play entertainment firm, while the technology arm can focus on its connectivity capabilities without the baggage of unrelated business operations. This unprecedented move not only reflects Comcast's commitment to maximizing shareholder value, but also serves as a blueprint for other industry giants. Historically, conglomerates like Comcast have faced challenges in delivering clear value to shareholders. By splitting its operations, Comcast is responding to a growing demand for transparency and specialization in an increasingly competitive market. This change may prompt rivals, including AT&T, Verizon, and Warner Bros. Discovery, to reassess their own structures, potentially leading to a wave of similar transformations across the industry. The implications extend beyond corporate strategy. They are likely to reshape investor perceptions and market dynamics. The impact on dividend policies and capital allocation strategies will be significant. Each entity may adopt tailored approaches to dividends, reflecting the unique financial needs and growth prospects of their respective sectors. The recent surge in Comcast's share prices underscores the immediate financial benefits of this restructuring, while also signaling a shift in investor sentiment. Analysts are now reassessing the competitive landscape of broadcasting, wireless, and entertainment sectors, anticipating a period of heightened innovation and investment. For consumers, this separation signifies a fundamental change in how media and technology companies will operate and compete. As distinctions between telecommunications and entertainment become increasingly blurred, understanding these developments will be crucial for navigating future investments and consumer choices. The evolution of the media and technology landscape is poised to accelerate, with companies adapting rapidly to meet changing consumer demands. Looking ahead, the separation of Comcast's businesses is likely to foster more focused competition and innovation. Investors and consumers alike should prepare for a transformed marketplace where specialized firms can thrive and respond more effectively to emerging trends. In this new era, the emphasis on specialization will redefine success in the media and technology sectors. On June 30, 2026, Comcast Corporation announced a groundbreaking decision to separate its media and technology businesses into two independent public companies. This strategic move, facilitated through a tax-free spin-off, aims to unlock value by allowing each business entity to be assessed on its own merits. The media and entertainment segment will retain control of NBC Universal, which encompasses NBC, a diverse range of theme parks, and prominent film studios. Additionally, Sky, the European media giant, will also be part of this new media entity. Meanwhile, the second company will concentrate on wireless, broadband, and connectivity services, leveraging Comcast's existing infrastructure strengths. This momentous announcement led to Comcast shares surging by 22 to 23% ahead of the market's opening. Investors in NBC Universal and Sky also witnessed renewed interest, driving up their stock prices substantially. The context surrounding this decision is rooted in a rapidly evolving media landscape. As streaming services and digital content consumption continue to rise, traditional cable companies have faced increasing pressure to adapt. Companies like Netflix and Disney Plus have revolutionized how audiences engage with media, prompting legacy players to rethink their strategies. By splitting its operations, Comcast aims to position each business unit for success in their respective fields. The media sector can focus on content creation and distribution, while the technology sector can streamline its connectivity services, potentially enhancing customer experiences. The impact of this restructuring extends beyond Comcast itself. Charter Communications saw an impressive 20% increase on speculation of a potential partnership with SpaceX in mobile services, while Rocket Lab's shares rose by 11% following their announcement of an $8 billion acquisition of Iridium Communications. Industry analysts view this spin-off as a pivotal moment in the ongoing transformation of the media and telecommunications sectors. The move is expected to inspire similar corporate strategies across the industry as companies seek to align their operations with market demands. Looking ahead, the outlook for both new entities appears promising, as they will be able to pursue tailored strategies that align with their distinct business models. This separation not only highlights the necessity for companies to adapt to market demands, but also sets a precedent for future corporate restructurings in the industry. As both companies embark on their independent journeys, they may redefine their roles in a competitive landscape increasingly dominated by digital innovation and consumer-centric approaches. As we anticipate the impact of Comcast's split, how do you think this will reshape the media and technology sectors? Share your thoughts in the comments below, and don't forget to subscribe for more daily deep dives.